Last week, I did a video called 5 Reasons Not to Take Your Pension Tax-Free Cash, and it's fair to say that that one went down pretty well. There were loads of comments and lots of calls for the flip side to that. Reasons why it does, or it might make sense, to take your tax-free cash from your pension. So, let's get into it. Hi and welcome back to the channel. My name is Pete Matthew. I'm a chartered financial planner based here in the UK. So let's get straight into reason number 1 that you should or you could take your pension tax-free cash. And that is the simple reason and the most obvious one, because you need the money. If you've made it to retirement and your only assets are maybe a paid off home and a pension pot, firstly, that's pretty good, well done. But if that's the case, then there's likely some clear merit in taking some or all of the cash out of the pension fund to be able to draw on it if you need it. Now, a lot depends on your income needs in retirement, so I would still think very carefully about commuting DB pension income, final salary pension, giving some of that up in return for a lump sum, if you're going to be very dependent on the income. Now, if you have debt, you should definitely look at whether taking tax-free cash could be used to pay that debt off. Some of you might even have taken out interest-only mortgages in the past with pensions as the repayment vehicle. Now, hopefully that was reviewed long ago and you're no longer dependent on the pension to pay the mortgage off. But I bet you there will be somebody watching this where that is the case. So maybe you need the money. That's reason number 1 why you should take your tax-free cash. Reason number 2 to consider taking your tax-free cash is because you have a DB pension scheme. Now, hear me out. Remember, with a DB scheme, you have a guaranteed income for life. That income is probably increasing with inflation, and likely there will be some benefits payable to your spouse if you die first. Now, with some schemes, there's a cash payment no matter what. You have to take it. But with others, you will have the option to draw cash in return for a reduced pension. Well, why might you take that option? Well, you should look into something called the commutation rate first. And that is the answer to the question, what is the amount of pension that you have to give up to get the lump sum that you require? Or, to put it another way, how much lump sum would you get for every £1,000 a year of pension that you give up? What you could do with that rate then is to say compare it with annuity rates on the open market. So maybe you could use the cash to buy an annuity with better terms than the DB scheme. That's probably unlikely, but maybe. You could make an assumption about what investment return you might get if you took the lump sum and invested it, and maybe compare that assumed return with the scheme income. Remember to factor in inflation if you do that. So what you're doing is you're comparing leaving the cash in the scheme and getting a higher income with the rate you might get if you took the cash out and bought an annuity, and also the return you might get if you took the cash and invested it. Remember, with the investment option, that's very much not guaranteed, as opposed to the income being definitely guaranteed from the pension scheme. So that should be a factor in your decision. But if you reckon you can do better with the money than leaving it in the DB scheme, then that might be a reason to take your tax-free cash. Reason number 3 to take your pension tax-free cash is if you have a very uneven split between DC pension funds and other money. Some people get to retirement and they have decent pension funds, but next to nothing, for example, in ISAs or other more accessible options. Now, when I get clients in this situation, I would always consider the merit in evening up this balance, really just to give them more options from where they might take income and capital that they're going to need in the future. Ideally, you don't want to be in a position where your only liquid asset is a pension fund, and hence everything you take in future is potentially taxable. Because if your cost of living rises ahead of the change in income tax bands, for example, you could end up paying a lot more tax in future because you've only got a pension pot to draw from. That would lead to a higher drain on the pot. You could end up in a vicious loop, which means that the pension fund could erode very quickly. Whereas instead, you could take the cash and invest it, ideally ISA it over time, so that it's accessible without tax implications in the future. Now, we're going to get into the meatier reasons to take tax-free cash in just a sec, but if this is useful so far, you know what to do. Please take half a second, hit the like button, subscribe to the channel if you're not already. It really does help, so thank you for doing that. Okay, reason number 4 why you might consider taking your tax-free cash is if you have a lifetime allowance issue, or you think you might do in the future. Now, I've done other videos on how the lifetime allowance works. I'll link to one up here and I'll put it in the description as well. But by crystallizing your pension pot early and taking tax-free cash, you might be able to reduce the impact of the age 75 lifetime allowance test, or the test if you die before age 75. So for example, if you're age 60 and you have a £1 million pension fund, you could crystallize that, take the tax-free cash, and that would be within the current lifetime allowance. No tax to pay. You would have $750,000 in a drawdown fund still, which you could draw from over time to keep it from growing too much in the coming years. Hopefully, so when the test at age 75 happens, it won't take you over the remaining lifetime allowance you have at that time. Now, the numbers are going to be, of course, unique to every individual, but it's easier to keep a smaller pot from growing in excess of a fixed lifetime allowance than it is a larger one, because, a 5% return on a £1 million pension fund is a bigger number in pounds than 5% growth on a £750,000 pension fund. So, if you're running close to the lifetime allowance and you want to consider your options, then it might make sense to take the tax-free cash earlier. By the way, I deal with this and I provide the software tools and all the help to run those numbers very easily in Meaningful Academy Retirement Planning. The link for that is on the screen now, and I'll put it in the description so you can check it out. But maybe that will help you answer some of these questions for yourself. And also, by the way, some people tell me off in the comments for only talking about big numbers in pension funds and stuff like that. £1 million pension funds, £500,000 pension funds. Well, these are the pension fund sizes where some of these things become an issue. So that's why. I know that not everybody has pension funds of that size. Reason number 5 to take your pension tax-free cash is to keep your income tax down, possibly. Now, if you take tax-free cash from a DB scheme, your scheme pension income will be reduced and hence you'll pay less income tax. If you're in a DC pension scheme, or you've got a pot, well, you could theoretically take the same income from your remaining fund after tax-free cash than you could if you leave the tax-free cash in there, but you'll have a smaller fund, so it's going to erode more quickly for sure. So let's say you were thinking to take £10,000 a year out of a 200 grand pension fund, 5% withdrawal rate. Well, let's also say that you've already used your personal allowance with other income, perhaps from a DB scheme, so you've got no personal allowance left. So everything you take from a pension is potentially taxable. Well, thinking that through, you could take the £50,000 tax-free cash available from your 200 grand pension fund, whack that into ISAs over 2 or 3 tax years, draw a quarter of the income that you need off that. That's £2,500 a year. And that would be tax-free, of course, because it's from ISAs. The other £7,500 a year that you need, you can draw that from the remaining pension. Now, of course, if you leave the tax-free cash in, you could do an off-plus withdrawal of 10,000, and of that, 2.5 grand will be tax-free anyway, which achieves the same end. And we talked about that in a previous video too. I'll put a link to that in the description and up here. So it's safe to say, folks, as always, there's many ways to achieve your ends with this stuff. And finally, reason number 6 to take tax-free cash is what I'll call beneficiary considerations. So if you have no beneficiaries, no one to leave the money to, then the inheritance tax benefits of leaving money in a pension that we talked about earlier, well, those are irrelevant. If you don't care about leaving a decent pot, you can probably spend more money earlier, and having cash in the bank to do that up front might be the ideal solution for you. As long as you don't hamstring your future financial security by spending too much too soon and then living too long, well, taking your tax-free cash out to blow on some great experiences, while you can, sounds like a great idea to me. If, on the other hand, you're in a DB pension scheme and you do have beneficiaries, which are not your spouse, or your kids maybe, well, the DB income won't go to them. It'll stop when the second of you and your spouse dies. And so by taking out the tax-free cash, maybe giving it to them up front or just not spending it and leaving it to them in your will, well, at least they'll get something. Yes, it's going to be part of your estate, probably. You might pay inheritance tax on it, but 60% of something is better than 100% of nothing. So hopefully, folks, over the last 2 videos, you're getting a sense that there might be multiple and potentially conflicting reasons why you should or shouldn't take your tax-free cash. Don't know about you, but I find that really annoying. If only there was a clear-cut answer to this stuff. Well, actually, I'm kind of glad that there isn't, because it keeps me and my company in work. But the reason that is the case is because of the unique circumstances of absolutely every individual and family. Everybody watching this video has a unique set of circumstances. So for some, the implications of having a lower income outweigh the possible income tax issues of having a higher income. Or the impact on beneficiaries might be a bigger factor than income tax while you're alive in the short term. Everybody's different, and probably, I'm afraid to say, you will find that there is no optimal answer. Just a bunch of possible options which you'll have to weigh up, decide which route you're going to take, and then own the decision. Whatever you do, don't look back in 5 or 10 years' time and second guess and regret a decision which you can't unmake. So usually it's a balance of reasons and no one reason that will apply to you and your circumstances, and you just got to make the best of it. So, should you take your tax-free cash or should you not? Good luck making that decision. I wish I could make it easier for you, but I hope this was helpful, folks. If it was, please remember, hit the like button, subscribe to the channel if you're not already, and I'll see you in the next one.